No, I mean, for the real estate people, you only really want to call them up if you've got something going. Otherwise, they're gonna like perceive you as a time waster and not return your phone calls ever again.
Welcome to the Bulletproof Cashflow podcast. Let's get into the show.
Hey everyone, it's Agostino. As you know, we're always looking to build that bulletproof cash flow to build lasting financial freedom. Now, one great method is using net leasing investing and to preserve wealth and, of course, build that cash flow, that regular passive income. Now, today's guest understands how to do all this. And he's been a real estate entrepreneur and security token evangelist who is also an expert in retail real estate, like shopping centers, like the ones that you're very familiar with, such as Starbucks or Taco Bell, those types of things as well. There's a single tenant net lease investments too. Now, he has an extensive record of partnering with some of the world's best known banks, insurance companies, and hedge funds over the past 34 years. He's been featured on the Real Estate Guys radio show, Cashflow Ninja, and Bitcoin.com, among many, many other shows. Now, additionally, he's also a published author, having been featured in the #1 Amazon best-selling book, Desire, Discipline, and Determination. Now, with all that, I'd like to welcome my good friend, Michael Flight, to the show. Michael, thanks for coming on, man.
Thank you very much for inviting me. It's a pleasure to, well, we actually met down in Houston live at a real conference. And, I really appreciate you inviting me on.
Yeah. No, hey, I think you're going to offer a wealth of value here to the audience. I think it's going to be great. I think it's going to be super. Now, guys, if you like what Michael has to say, you can reach him via his contact page at michaeljflight.com. Okay, Michael, go ahead and tell listeners a little bit more about how you got your start in real estate and how you got your start with this whole net leasing thing.
Okay, well, I got my start in real estate back in the 1980s. So, and my brother and I went to one of those no money down seminars, and we figured out that we actually needed some money, or at least some sort of income to show. Otherwise, we couldn't buy real estate. So, make a long story short, I ended up as the next entry level into real estate investing, which is a commercial real estate broker. And so since people tell me that I was either efficient, I put it down the lazy. With retail real estate, if you get a tenant that wants to expand, especially I'm originally from the Chicago market, I still live here. A tenant coming in like Ross or, Marshalls or Old Navy, those guys can do up to 30 stores in a market. And so why wouldn't you do that where you could do like 1, 5, 10, 20 stores with one tenant, it's one contact, versus going door to door, knocking on doors in an office building, doing the one lease, and then having to start all over again, cold calling. So that's how I started my career in real estate. It's also been helpful because with that, I developed relationships with some of the people that do, because most of these major national tenants have what are called real estate representatives. So they're the guys that make the decisions as to where the properties go. So if you're working with a Dollar General, you're working with a Dollar Tree, you're working with, McDonald's, they're typically have a real estate rep that covers sometimes the entire country, sometimes a certain market. And if you develop a relationship with those people, they'll tell you, well, we really don't want to go there, but we want to go there. So can you find us a piece of dirt? Can you build it for us? Can you put the deal together? So that's kind of, what my initial start in retail real estate was real estate brokerage. And then I went to work for a major national syndicator. They owned about 270 shopping centers nationwide. And then in 1990, the savings and loan crisis happened. So the United States started going into a recession right around 1988, and we were in the depths of it in 1990. So a partner and I started our company, Concordia Realty, and we started managing leasing and then being the operating partner in purchasing shopping centers. And what we specialized in was redevelopment of shopping centers.
Nice. Excellent. So now the thing is with shopping centers and talking about malls and all these things, it's a whole different dynamic than what we usually talk about here on this show. We talk about multifamily, we talk about single family, we talk about land. When it comes to net leases or even triple net leases, which is probably a little more common term, maybe explain what is all that? What is a net lease or a triple net, and what does it stand for?
Well, it's why you and I both love net leases. Net leases means that the tenant maintains and takes care of everything. So basically, when you are investing in a single tenant, not necessarily, they also consider shopping centers triple net, but you still need to maintain the roof and the structure and some other things. But with a single tenant building, like let's say you're looking at a Walgreens, or as you mentioned, that Starbucks standalone building, the Starbucks is paying the real estate taxes, the Starbucks is paying for the insurance, not only inside their store, but also liability insurance on the building and property insurance. The tenant is also paying for maintaining the parking lot. So if you live in an area where I live or where you live, you get snow, they're paying for snow plowing, they're paying for cleaning the parking lot. And if it's a pure triple net lease, they're maintaining the structure and the roof too. So I like to, let people know that they can remember what a net lease is. It's also sometimes abbreviated as NNN, which stands for net, net, net. And those three nets are taxes, insurance, and maintenance. And you can remember it with the acronym TIM.
Nice. And the thing is, though, is that ever since I found out about triple net leases years ago, that's one of those things that it's a remarkable business, only because it's just as you said, everything's covered by the tenant. They're paying for all the expenses, right? Sure, the returns may not be the same, but they're going to be somewhat stable, right? And usually you have a corporate guarantee that's behind it as well, which makes it even more inviting, right? I mean, that in itself is absolutely huge, right?
Yeah, so you just hit on the two other, real big benefits. So the one benefit is the tenant pays all the expenses, and you just hit on the other two benefits of net leases, which are these tenants normally do long-term leases. We have had tenants that have actually signed 50-year leases. I like to tell the story of a Walgreens, which we still have, that was in a shopping center, and the lease was done before zip codes. And it was done on parchment paper and, carbon copies and things like that. And then we moved them out to the out parcel and did a 50-year lease with them, because this Walgreens was it still is. It's up in the top of their chain. They're just doing huge volume there. And not only that, then you hit on the next thing. So it's long-term leases. So you have your rent locked in. You know that your expenses are controlled because the tenant is controlling expenses. So you can plan, for up to 10 years, 20 years, however long the lease is, as long as the tenant's there, it's like having a bond. They're going to pay you monthly, and it's monthly income. And you are not taking care of toilets, you are not taking care of trash, and you're not dealing with tenants for the most part. So, but the other really great thing that you hit on, and what we really like, is it's guaranteed by a corporate tenant. So, like, let's say you're doing a 7-Eleven. 7-Eleven has, I think, close to like 50,000 stores. They're a major international company. They're a Japanese company. They're just super huge. And sometimes you'll get an actual lease with, an Exxon if you're doing that. I mean, you would almost sometimes trust the credit of Exxon versus the U.S. government right now. So, I mean, that those guys are going to be around. But like I said, Starbucks is a going concern. So these tenants are going to pay. And the great thing about these tenants is they're very concerned about their credit rating. So you get the lease typically sent to you in what's called an ACH payment. So it gets put directly into your bank account. You don't even have to go to the mailbox to get it anymore. And it's usually there 7 to 5 days before the beginning of the month. So you're not worried about, oh, is this tenant going to come in and trash my place? Is this, tenant going to pay the rent? If there's a pandemic, is this tenant going to lose his job? That type of thing. These, if you look at the occupancy rates, especially over the last 15 years, the highest occupancy rates are single tenant net lease properties across the board.
Wow. But I'm getting, but the thing is, though, is that you are, in exchange for that, you're going to get a slightly lower return, right? You don't get all the same upside you would on, say, a multifamily, that a value add multifamily, or maybe even an A-class multifamily. You're going to get an entirely different play, right?
I would say that sometimes you're getting a better return than an A-class multifamily because, as you know, those multifamily cap rates are pretty low, and you can get an A credit tenant for in the 5.5. I mean, the 7-Elevens in a Texas 7-Eleven is crazy, because it's like a 4.5 cap right now. So, but and I believe your people know what caps are, capitalization rates. If they pay, that would be their return, all cash. But you can get some other, relatively well-known brand name tenants, and out of the box, you can be, 5.5 to a 6, cap rate. And there's built-in rent escalators, which is why we like a lot of these tenants. We have to make sure, because there's certain tenants like Dollar General that they'll do a flat lease for 15 years, and we try to avoid those. We want the tenants that have built-in rent escalators. They typically are built in every 5 years. And a lot of tenants, especially the medical tenants and some of the other automotive service tenants, they have rent increases every year. So those are really nice. So you might be buying it, like, let's say you're buying it at a 5.5 cap. There is rent growth in there. And the other thing is, I take a look at a lot of these, value add apartment buildings. And so at the end of the day, there might be, everybody's looking at like these IRRs, and, sometimes I don't really trust the IRRs because it's like, that's all based on what the performance of, whoever the, property manager or sponsor is. So, the going in cap rate on a lot of this stuff is the multifamily is 4.5, 4 cap. And if you don't get the bump and something happens like a COVID or something like that, your rental rate is not there. I will say that there is a higher probability that if you're an efficient operator, you could probably get the rent bump and you could force appreciation, but it's also tough to do in, a lot of markets versus how much are you working for to get that rent bump? And, how much, what's your risk return reward profile? Because, why not just grab this immediately, which is like, the 5 to 6 to 7 cap out of the box, which you're getting immediately versus, I'm going to build up to something like that, in 2, 3, 4 years.
Hey, Agostino here, and I would love to connect directly with you. Text the word books to 202-410-4202 to receive weekly book recommendations from me.
Yeah. And you know what, though? And that's a very good point, because on, just like you said, like on a multifamily deal, you're going to have move-ins, you're going to have move-outs. Even on an A-class asset, you're still going to have to go in there, paint. You're going to have to do something to renovate the property, even a little bit. They're probably not going to totally trash the place, but you're going to have to do something to it to make it better. That requires overhead. It requires extra capital. It requires people to keep an eye on it. You have to have managers there, the whole shebang. But when it comes to a triple net, which is the ultimate one, an absolute triple net's the best one, if they decide they're going to change their logos, change their signs, that's on them. They're paying for that. They're paying for all that stuff, right? So it sounds like to me, even though technically it could be less of a downside, because I would imagine that you're able to refi some of these properties on, like, say, on an A-class cash flowing multifamily asset. Sure, you can do a refi and pull out a bunch of cash. On a triple net deal, for instance, I mean, I know I'm assuming you can finance that too, obviously, and then you can also refi it, but you're probably not able to pull out the same type of cash out of that thing, right, and return it to the investors.
Well, multifamily is heavily subsidized, and don't get me wrong. I mean, I've done multifamily in the past, and we've done everything from condo conversions to, single family house flipping. I've really been involved with it all. My preferred, reason for going with single tenant triple net leases is because we did some extremely complicated deals. So, like, we've actually demalled, which is taking malls and, demolishing them, emptying them out, and repurposing the malls. And so those are heavy lifts. And so at the end of the day, you can get a really nice big reward for that, but it's also, house flipping on a giant scale versus I'm at the point right now in my career, and I'm at the point right now where it's like, I've done a lot of this stuff. I have made money, doing this stuff, but right now, would I rather just put the money into this and know it's going to be there, and it's less hassle. But the other thing is that what you didn't bring up with, even if it's a Class A multifamily, you've still got time managing it. I mean, you got to either manage the manager or you got to, manage it yourself. Versus this, there are management responsibilities, but very few management responsibilities. And so then you would just ask me a question and I forgot it. So I apologize.
It's probably on the refi. So,
oh, okay. That's right. So, multifamily is heavily subsidized. So you can get into it with a lot less money, in terms of leverage and, what your loan to value ratio is. But the great thing is if you have a credit tenant, most of the time the bank or the lender is going to look to the credit of the tenant. So you can avoid personal guarantees depending on the type of tenant. So, or if you can get a portfolio of properties where the lender says, oh, I can see that I've got some, security here because this loan is collateralized by a few different tenants. Then, number one, we'll give you more money. And number two, we will give you, you won't have to sign on a personal guarantee. There is one opportunity, which is, your cash out refi or your sales. And that is, like I was saying at the beginning, if you have a relationship with one of these tenants and they're expanding, then you can build for them. And that's how you add all the value. So if you can build for them, deliver the type of store that they want, you've probably got, let's say the Dollar General model, because I've got a really good friend that's head of real estate over there. So they can build their store for around $100 a foot. And then these developers can then flip that store, after it's brand new and built for somewhere around $300 a foot. So so you could either do that or you can, refinance it and be in it for the long haul. So that is one way to add value. The other way to add value is it's a riskier strategy, but you take a net lease that is in an excellent location, but the tenant has an expiration coming up within, 1 to 3 years. So you can get that at a higher cap rate. And if the tenant has options, likely are, if they're doing well there and there's ways you can check it, the tenant will exercise the option. And if you know what you're doing, if the tenant doesn't exercise the option, sometimes we like that better because the tenant was in there, paying a reduced rent and it didn't keep up with the market. So we can re-tenant it with, a better tenant that's going to pay more rent.
Yeah. Well, a buddy of mine just did that. He actually just bought an asset. He paid, I think he paid like a 10 cap on an Advanced Auto Parts in a great area. And there's, I think, 2 years left on a lease. He made a phone call. They renewed for another 10 years. Super. Great deal. And
yeah. So, but you do take a big risk. So you better be sure that you've got somebody else that can backfill that, or you've got a broker that's competent in the area that can backfill that for you.
Right. Well, it's the same thing as what we talk about in other asset classes, and it's no different here. Is that you have to have a real good team to back you up when you're getting into these deals. But that sounds to me like that game is really a Jedi move. I mean, if you're going to start getting into net leases, don't let that one be your first one.
Yeah, no, exactly. I was just going to say that's not your starting dive. You start out with let's just do the and then we'll get to the 10 degree of difficulty. But and you would want to, because the other thing about owning the real estate is you develop a relationship with the tenants. So you are going to be, you're going to work with some of their real estate managers. You're going to work with their accounting department and things like that. So it'll give you a better idea as to what these tenants look for. You've got some relationships and you'll have some confidence in dealing with them in the future. But if I were starting out, I would not look at a lease, with less than 7 years and make sure that it's got some rent bumps in there.
Yeah. Now, so, and that in the regard of actually reaching out and getting to know the people at the actual at corporate. So, are you actively maintaining those relationships? And like, you calling them every quarter? You're reaching out to them. You're sending them fruit baskets and stuff like that. Is that what's going on? Or
No, I mean, for the real estate people, you only really want to call them up if you've got something going. Otherwise, they're gonna perceive you as a time waster and not return your phone calls ever again. So, and I can, I'm not bragging. I'm just saying that I've got relationships, that I've had for 30, years. I started out with people that might have been, like the lowest guy on the totem pole at, some shoe company, and now they're head of real estate in, one of these large corporations like Walgreens or something like that. So, that's just comes over, years and years of dealing with people. And the other thing is that I am a member of a group called the International Council of Shopping Centers. So if you do have to lease your properties, if you do have a vacancy, the International Council of Shopping Centers is a area where people that have shopping centers and tenants come together and they can meet, and it's basically what we call deal making. So that's another way to build up relationships. But the best thing to do, especially with this, if you're just starting out, is to also develop a relationship with a commercial leasing broker that specializes in the area that you're working with. Because they'll give you a good idea as to, you would even call them up and say, look, I'm looking at buying this property, and you're leasing the space across the street. How has things been? Do you guys do reports on the area, things like that?
Yeah. Now, in terms of other benefits that with these single tenant net leases, you do get to use depreciation. You do get to take advantage of some of those other things too, right? Like you do in other asset classes, correct?
I'm going to point out, so there is a triple net lease, which you own the building and you own the land. And then there's a thing called a ground lease. And with a ground lease, the tenant, all you do is lease them the ground. The tenant builds the building. The tenant maintains the building. The tenant does everything. You have no depreciation on a ground lease because you can't depreciate ground. But that is the most safest investment that you could make, a ground lease with a national tenant. So those always have the lowest cap rates, but those are just like buying a bond. So you don't get the benefits of depreciation. With all the rest of this, you can do depreciation. You can get a cost segregation so that there's other things that you can accelerate. And there's even special tenants out there. It's going away now, but right now, gas stations and convenience stores, but if they have a gas station component, the federal government qualifies them as a fueling center. So you get accelerated depreciation for buying a gas station. That's going to go away within the next 2 years, and it might go away much faster with the current Congress and administration. Because the current Congress, the current administration also does not like what are called 1031s, which are 1031 exchanges. And so if you'd like, that's the thing where the intersection of multifamily owners and net lease property investors most commonly intersect, because it's usually people a little bit older than you that get tired of doing the multifamily, that get tired of doing all the work, and they're around the age of me, and they decide, usually a little bit older, they said, I'm going to ease out of this, but I don't want to take all the capital gains tax, and I don't want to have to mess around with that. So I'm going to sell my apartment building in 1031, and they typically 1031 into a net lease property because they don't have to worry about managing it. Again, it's what we call mailbox money. And the way I like to describe net leases is they're like bonds wrapped in real estate. So you're just buying the credit of the tenant. Plus you get the beauty of depreciation and all the rest of it, and the tangible benefits of a hard asset.
Oh yeah, no. Hey, that's why we do it. We do it so we can offer our investors different vehicles to get into different things. Some people love doing the whole multifamily thing and the value add. We do that. We do development, and of course the net stuff. We just love doing that as well. So that's why we do it. And you're absolutely right. Some people, they just want a coupon. Yeah, the returns may not be the same as taking a C class and bumping it up to a B and doing a refi and pulling out a whole ton of money out of it. But on the net lease, it's consistent cash flow delivered usually on a monthly basis. So it's how do you beat that?
Right, and both you and I agree that we need to get more money out of Wall Street and into Main Street, and the way to do that is that if you're looking at a multifamily value add deal, that's your growth stock. That's your, startup company type of thing. And if you're looking at, the net lease properties, that's your bond. So you're going to want to have a diversified portfolio because, you might hit the four bagger on some of the stuff, and sometimes it might not all go well. And you've just got the net leases there just kicking off that consistent monthly cash flow.
Yep. Yeah, love it. Now, something you touched on a second ago when it comes to just buying the land and ground lease, basically, and then they just improve it, right, by putting a building out. So now, how are those leasing costs and those tenant improvements? How do you negotiate those things? How are they negotiated?
Well, there are no. So you just basically negotiate the lease based on the value of the land. So it's typically a multiple of the value of the land, and that the tenant pays the rent on that. It also, with retailers, if they're not going to make money there, they're not going to, it doesn't matter whether, you give them the least amount of rent or the highest amount of rent. If they don't make sales, they're just not going to be there. So you'll see in a lot of situations, tenants will close the store, and they'll continue to pay rent, but they'll close the store because it costs them less money to sit there and pay rent than it does to actually operate the store. So, and we've had that where, the tenant has, sat there and paid 5 years on a vacant store. So, but, because they're obligated under the lease to do that. But the other thing is that, so it's really with the ground lease, it's a matter of, dirt costs. So how much surrounding area, the dirt is, and it's typically a multiple of that. And then with the build to suit type of deal where you're going in, you've got a relationship with McDonald's, and McDonald's says, this is our prototype, build this for us. And so you do the build to suit for them. It's usually you're going to calculate how much your rent is based on your land cost and the cost to build it. And, what your payback period is, and what, you're also going to take, a risk, multiple for your carry.
Yeah. Well, I think part of it is I think it's a good idea to have a very good attorney when you're doing all this, because if you just hire anybody, you're going to get burned. It sounds like.
Absolutely. So I want to really stress the fact that the big thing is if you are doing a lease with a tenant, you need an attorney that knows how to do a lease. So I've been on phone calls, and I'm not going to say, I'm an attorney, but I probably know more about the lease than your average attorney because they don't do, retail leases. They're not. So you want somebody that knows how to do commercial leases, and especially if you're dealing with a retailer, retail leases. And then you want a property attorney. And as I just told somebody the other day, you want a syndication attorney or a securities attorney. You don't want your guy most of the time to be doing everything, all in the same package.
Yeah. Yeah. Now, there's this big concern about the Amazon effect, right? People are always worried about the whole online thing and people just buying everything online, shipped to your door, all that stuff, which I think is great. But, people are concerned about it. I was actually talking to an investor just last week about it, and he had just general concerns about getting into triple net. Now, how's brick and mortar, how is that adjusted to these technological innovations that we're now seeing in today's market?
Well, the Amazon effect is correct, but everything is not going to go online because, even during a pandemic, everything didn't go online. People still went to the grocery store. People still went to the dollar stores. More than ever, people had to use pharmacies. People keep saying, well, Amazon's in pharmacy and they're going to disintermediate pharmacy. Well, if you look at, a CVS, a Walgreens, less so a Rite Aid, but those guys are almost, it's exactly the same thing as a dollar store in the front, and it's a little bit of a convenience store. And then the pharmacy part. But the key thing that I really like pharmacies, even if pharmacy goes away, most of these guys, and you want to make sure that if you're buying a pharmacy, that they have a drive-through, because it's really difficult in a lot of markets to get a drive-through approved. So if the drive-through is there, you don't necessarily have to re-tenant it with a drive-through. You could actually, put fast food or somebody in. But Amazon isn't going to disintermediate fast food. Amazon isn't going to disintermediate a lot of the stuff because there is what we call necessity businesses. And so, and really, I think even after COVID, and I'm not sure if the new numbers have come out, but I don't think that, online sales are much more than, 25%. And as of like 2019, online sales, I think were around 18% of total, sales volume. So, and the other thing is that no matter how much you lock people down, no matter how much some people like to do a Zoom call and all the rest of it, there's the majority of people that just want to get out. And so there's drudgery of shopping, but there's also the, what we call, entertainment type of retail, or the people like Marshalls and Ross, which is what they call the treasure hunt retail. And it attracts women mostly because they go in and there's always something new. So they keep going there. And it's also difficult to buy, for women to buy makeup and other things online. And then this is the real killer. And I'm just going to go back to this. I know, dress guys that own stores, and they, one chain, he's a friend of mine. He owns like 50, women's fashion stores. He's talking about his daughter who was buying, a wedding dress, and they just ordered 6 wedding dresses to try on, and then they sent back 5 of them, and so that's the biggest killer, that a lot of people think that, well, we're just going to go straight, retail, and we're going to make a lot of money. Number one, you have to spend a ton of money on what's called search engine optimization to get people even to your online store. But the other thing is, returns are, I think returns are something like 30 to 40% of every sale bought online. So a big triple net thing that we haven't talked about is industrial triple net, so like distribution facilities and stuff like that. But the biggest industrial expansion right now is not only last mile distribution, but it's also return processing distribution, because they have to have some place to take those returns, process them, and then, put them someplace else.
That sounds expensive, man. That sounds very, very expensive, especially that example there. It's like, I can imagine. So here's a woman that she orders 5 dresses, returns 4 of them, and people don't even think about it. Well, you need infrastructure to handle all that. So someone's got to receive it. So if there's labor costs right there, they got to open it up, check that it's there, put it back in the inventory, take it, put it back on the shelf. And if you know anything about moving inventory, you do not want the inventory back on your shelf. You want it out the door and never see it again.
Right. And I think Amazon found out, but most of these stores and merchants have found out that you actually can't take the stuff back into the same spot. You have to bring it to a different place because you've got all this distribution going, one way, which is out, and they're not equipped to like unwrap the stuff, clean the stuff off, repackage it, and all the rest of it. So it's 2 separate facilities.
Do you think that's sustainable long term, doing it that way for those companies?
I don't know. The thing most people don't realize, number one, Amazon owns a lot of brick and mortar stores. So that's the other thing that I go to. Amazon owns Whole Foods. Amazon is opening up grocery stores that are branded Amazon Fresh. And they destroyed the bookstore, and now they're reopening bookstores. So they're opening up a lot of different brick and mortar. So they found out that, they need a physical presence. But the other thing is almost their entire retail operation is in some respects a loss leader, because, Amazon makes the large majority of the money selling web services, Amazon cloud services, to not only large corporations, but I think they're one of the largest providers of cloud services to the U.S. government. So that's all that stuff that, the NSA is spying on you goes into Amazon Amazon Web Services.
Right. Like this conversation right now.
Exactly. Well, this might be going, since it's Zoom, it's probably going through China too. So
there we go. Oh yeah. Well, and I think that's the thing though too. It's like I know that Dollar Tree, all the fast food joints, the ones that were open during COVID, all of them, their sales are up. They've been solid performers even through all this pandemic stuff. So it's to me, it's still such a great business to be in. It's a huge business to be in. It's just phenomenal.
Right. And I think Dollar Tree and Dollar General are going to give back some of that, but I think it also cemented in people's minds that might not have normally shopped at Dollar Tree and Dollar General and 99-cent store on the West Coast. That's like, oh, this is an option now. I would have never thought to go in here, but this is one of the only things open. It's close. I'll go in here, and it might develop some shopping patterns that weren't there before.
Yeah. Well, I think that they replaced the general store. It's very easy to get in and out. And I think, but you're absolutely right. It's kind of like it's the only place that's open. They kind of reintroduce themselves to a whole new market potentially, and it's helped them out tremendously. It's probably why we did see all these sales just explode for them. So kudos to them. They did great. They did awesome with that.
Yeah, people my age, I say, well, originally it was the general store out in, the plains, and then the Sears catalog was the Amazon of their day and interrupted them. And you could even buy a house through Sears catalog, because in my neighborhood there's several Sears houses which were actually very nice. And then Woolworth and Ben Franklin and what was the other ones? Out by You, McCrory's and GC Murphy. Those were the dime stores, and those were basically what Dollar General and Dollar Tree have morphed into. So the dime stores and the general stores went away, but you've still got that. And like I said, that's really what's driving the front end of CVS and Walgreens have almost exactly the same stuff that Dollar Tree and Dollar General have.
Yeah. Oh, well, CVS is just way more expensive.
Right. That's what I'm saying, because they're hoping that you're going to buy it while you're waiting for a prescription. So, and those guys are also adding. So CVS owns Aetna Health System, and so CVS and Walgreens, in order to compete and make sure that they're positioned to compete against Amazon, is they are adding healthcare centers and clinics and all kinds of other stuff that. Because they've got some really valuable real estate.
Yeah, that's right. So, I mean, yeah, I think that net leases are here to stay. I really don't see Amazon or Walmart.com or whatever replacing all these the corner store of any kind. I just don't see it happening. That's my.
Well, I think net leases are here to stay, and there's all kinds of different ways you can get into the net lease. Like we talked about, there's industrial, which I am not qualified to speak on. I know enough about industrial real estate to be dangerous. And then even if you go out to Las Vegas, the MGM Grand and Caesars Palace are one giant net lease that, are operated by those casinos, but the real estate is owned by a real estate investment trust.
Yeah. There you go. Right. So, you know what, guys, if you're really comfortable doing, you want to know more about doing net leases, give us a call. All right. So Michael, if you had a piece of bulletproof advice to someone listening right now, maybe they are thinking about getting into net leases, or maybe they're just thinking about doing something with regard to either investing or maybe even buying one, what advice would you give them?
Well, what we noticed is that there's a lack of education out there for net leases. So I'm going to make a promotion for, we have a podcast called the Nothing But Net podcast. So it's Nothing But Net, NNN podcast. And it just goes through some of the things. And we try to do it on a step-by-step basis. So from, learning about your market, deciding what type of tenants you want to get into and all the rest of it. And then, we're, working our way through 1031s, through property management. We've had some these guys are like insane experts because they've been in the business. We just had a guy that does, net lease financing, and he's been in the net lease business since the 1980s, basically when it took off. He also ran a real estate investment trust. We had another guy that's on our board of advisors, Alex DiMaturco. And Alex, I think he's developed properties in like 40-something states, including Alaska and Puerto Rico, and they were all net lease. And he was also the president of, at the time, the largest net lease real estate investment trust. So we get some heavy hitters on there that can give you a really good idea of the net lease business. And then the other thing I would recommend is if you are interested, just take a look at, there's really several good net lease boutique brokers out there. See what they have on their list. And then you can always contact somebody like Agostino or myself. And we'd be more than happy to, guide you in an area or talk to you about the pros and cons of doing it yourself versus maybe investing in a fund.
Yeah. Which I love doing. The fund model is to me superior because you're spreading out your risk. Well, already low risk situation. So, yeah.
Right. But that was the reason why we decided to create Liberty Real Estate Fund, because we wanted something super stable. We wanted something industry diversified. We wanted something geographically diversified, and we wanted something that is credit diversified. So the tenant of the credits. So we've got brand name companies, and that's why we decided to put it together, because you are risking a little bit more by putting all your eggs in one basket. You're spreading that risk around. So it's basically like a mutual fund, for real estate. Yeah. So if they wanted to get a hold of us and they want to learn more, we've got a lot of information on net lease properties at libertyfund.io. So we've got educational materials. We've got videos there. We've got webinars that we've done, especially one called the 8 Net Lease Secrets of Real Estate Investing. So if you're looking to get more information, they can go to libertyfund.io. Or, as I said before, they can reach out to me or Agostino, a little bit more knowledge on net leases, because both of us are really big believers in them.
Awesome. All right, guys. That's excellent. Now, if you guys want to reach out to Michael, you can reach him via his website at michaeljflight.com. Of course, you can also reach him at libertyfunds.io as well. So don't forget, go ahead and check out that information. It's going to be a lot of great info there for you. Hope you got some insight on how to grow wealth and get strong passive income using net strategies. Thanks for tuning in, and I'll see you in the next one. Take care.